Hello, everyone. I'm David Darst. On behalf of the family office, thank you for joining us today, the last day of November the 30th, 2022. It's been an amazing month, and as a matter of fact, the last 6 months have been kind of amazing. The market is unlike last year, where the market went up almost 28% with very few dips in the S&P 500. This year, the S&P 500 has been on a roller coaster ride, up, down, generally driven by interest rate changes or the outlook for interest rate changes or people's expectation of whether there's going to be a slowdown in interest rate increases or not. The month of November was up 5% for the S&P 500. You may recall that October was up 8%. September was down 9%. August was down 4%. July was up 9%. June was up 8%. So you see this up and down and up and down. In the U.S. Treasury yield market, the two-year Treasury closed at 4.48. It declined 6 basis points for the month. The 10-year Treasury went down 32 basis points for the month to close at 3.75. It had been 4.07 to begin the month. As you know, the 2-year is supposed to be below the 10-year, but we've had this yield curve inversion in which the 2-year has been above the 10-year. And at the beginning of the month, that negative inversion was 47 basis points. It has increased during the month to 77 basis points. This is the highest in 40 years that you've had an inversion that steep. And that's one of the reasons why we believe we will have a significant slowdown in the economy in the first half of this coming year, a recession, okay? Not a deep recession, but a recession nonetheless. The dollar for the month of November declined 5.2%. That's the biggest dollar decline against the major currencies in 12 years. Chairman Jay Powell of the Federal Reserve gave a talk on the last day of the month, November the 30th, at the Brookings Institution, which is a think tank in Washington, D.C. And at that speech, he said that the Federal Reserve is coming around to the thought that they want to slow the pace of interest rate hikes. And he then also gave indication that they might want to keep them at a high level, but slow the rate of increase. He said it's time to begin moderating. That was his exact words. The next meeting of the Federal Reserve, as you may know, is December 13th and 14th. That's the last meeting of the Federal Reserve Open Market Committee. January 31st, February 1st is the meeting after that. We then go all the way out to March 21st, 22nd for the second meeting of the year. And the third meeting is May 2nd, May 3rd. And then you get into June 13th, June 14th for the additional meetings. Let's give you our thinking right now on the 5 key critical points. One is inflation. The inflation is high, but it seems to be moderating. Consumer prices, the headline number for the month was 7.7%. The previous headline number had been 8.2%. The core, which is when you take away the food and energy, 6.3% versus 6.6% the previous month. That's for consumer prices. Producer prices, you had a similar decline, small, but nevertheless moving in that direction. So that's the inflation. That allows the Fed to start talking about moderating. We do believe we would want to emphasize that a less severe rate of increase is different from a pivot. A pivot is when the Fed says no more and they're going to start going down. That has not been announced. It's more he's saying we're just going to slow down the rate of increases, okay? So a pivot is different from a dovish increase. The third thing is the economy. And there, as you know, this first quarter of this year was minus 1.6%. Second quarter, minus 0.6%. The third quarter, and you got a new number for the third quarter just today, November 30th, up 2.9%. These are all annualized. And the fourth quarter is expected right now to be up 0.5%. So we'll see. That might be exceeded because this economy seems to be slowing, but not in an appreciable or measurable or meaningful way. Next year, we are expecting the first quarter to have a decline of 2.6%, the second quarter minus 1.5%, and then the third quarter up 1% and up 1.5%. So you see a shallow recession in the first half of the year before we begin to go up. Corporate profits, we expect this is really where the market could run into some turbulence and volatility, because we think that analysts' estimates right now are too high. And as we move into the slowdown, which we anticipate in the first half of next year, that you're going to get pressure on corporate profit estimates by the analysts as they begin to reduce it and the companies begin to reduce their guidance. We think the market could come in for some turbulence. The stock market, calendar year 2022, the fourth quarter, expected to be down 2.1%. For the fourth quarter of calendar year 2022, with the full year S&P 500 profits up 5.2%. Calendar year 23 is expected to be up 5.7% versus 2022, with the first quarter up 1.6% and the second quarter up 0.9%. You see, those are very small profit gains, and we think they're going to be revised downward. The key time is in mid-January. They begin to give the earnings results for the fourth quarter, and the company managements will be talking about the outlook for the first and second quarter. So we think this 1.6% gain and 0.9% gain is too optimistic and is probably going to be revised downward and have a minus sign in front of it. This leads us to our positioning as far as assets. We would be happy to have liquidity. We are happy to have some intermediate term fixed income securities or securities for yield. You want to have some private equity in there with good managers, and specifically focus on defensive. This is healthcare. This is consumer staples. This is utilities. So you want to have defensive style equity exposure going into 2024 and 2023. So bottom line, we think the economy will slow down in the first half of next year. We think profits will go down, the market will go down, and then we think there will be a rise as people begin to see the Fed reducing the interest rates, starting to reduce the interest rates in the second half of next year. That will lead, we think, the market to go up in the second half of next year, particularly as they're looking to 2024 profits, which we think will be substantially above 2023. Thank you for being with us today. We wish everyone a great ending to 2022 and look forward to seeing you soon.